What's up, everybody? Welcome to Heresy Financial. My name is Joe Brown, and recently, as you are probably aware, there has been heightened interest on the mechanics behind a short squeeze and short selling, and because of this, I've seen a lot of people that have been concerned, actually, that the shares that they own are actually being lent out to people who want to short the stock. And so today we are going to look at what does that actually mean if your broker's taking your shares and lending them out. Number two, how will you know if it's actually happening? How can you actually find out? And then number three, what are the pros and cons so that you can make a decision about whether you want that to happen or not? Ready? Let's dive in. As you're probably aware, the mechanics of a short sell, basically somebody wants to sell something that they don't own. So if you want to sell something you don't own yet, you have to borrow it from somebody else, and you can sell it. And then when you want to close out that transaction, you just buy it back on the open market and return those borrowed shares to whoever you borrowed them from. Now, for most stocks, most of the time, this borrowing is free. But every once in a while, you run into a stock that's called hard to borrow. And that simply means that there are a lot of people who want to borrow shares to sell them. Now, supply and demand governs this just like everything else, and so that means that it costs money to borrow those shares. Just like when there's heightened demand to borrow dollars or heightened demand to borrow anything, there's going to be a cost associated with that. Now, if you're trying to go borrow shares of Amazon or Apple, there's so many of those shares just being held right now that the ability to borrow them at no borrowing costs is free. I'm not talking about margin interest if your account is leveraged. I'm talking about the cost associated with actually borrowing the shares, and then you have to pay that interest rate the entire time you've got that short position because you've borrowed those shares. And then once you buy it back and deliver the shares back, that's when you stop paying the interest on those short shares. And then you have situations unfold like GameStop, where despite how much people are willing to pay on interest in order to short those shares, there simply aren't enough shares out there to go around for everybody who wants to short them. In fact, at many brokers right now, if you go to initiate a short sell on GameStop shares, you still are not able to. Now, obviously, this is an extreme example, but there are plenty of times when a stock gets to a point where the short interest is 10%, 20%, or I've even seen over 100% sustained for days and weeks. Now, this is an annualized interest rate, and so you're not going to pay the entire cost of the actual share price every day you have it shorted. It's an annualized percentage, and so you're going to pay that on a daily basis for as long as you hold those shares short. Now, you might be thinking to yourself, who's actually getting paid this money? If I'm looking at, let's say, for instance, MicroStrategy. That's a company led by Michael Saylor, and they've invested a lot of their cash into Bitcoin, and because of that, they've had a fantastic rise in their stock price. But you might be looking at this and thinking, hey, they've gone up too much compared to the amount of Bitcoin that they have, and maybe people are using this as a proxy to invest in Bitcoin in a more regulated way, since it's more difficult for certain funds and institutional investors to use GBTC since it's not an ETF. So you might be thinking, hey, it's overbought. Even if Bitcoin continues to go up, I think there's probably an opportunity to short MicroStrategy here. Well, you're not alone. As of this time, you might be paying somewhere around 2% annualized in order to short shares of MicroStrategy. And so you're thinking, who's actually making this money? Who am I paying that to? Well, the answer is it depends. And so to know who this money is actually going to, we have to look at the opposite side of the coin, how to actually participate or how to know if you're participating in the lending of shares. By law, a broker cannot lend out your shares to anyone for any reason without your explicit permission. However, you know how when you open a brokerage account and there's about 1,000 pages where you just have to click on, accepting the terms and conditions and consenting to all the agreements. You're just checking boxes over and over. And you know that, yes, you can always go and find these agreements at any time, but to be honest, who's going to read through thousands of pages of terms and conditions? Well, it's possible that depending on who you trade with, who you invest with, that buried inside those customer agreements, you have agreed to let your broker lend out your shares at any point whenever they want. Now, if you trade with any of the large, the discount brokerage firms like Schwab or Fidelity or Interactive Brokers, most of these have separate programs, and they're usually called something like securities lending or the yield enhancement program. And they do not lend out your shares without setting up specific accounts for this, signing up with specific agreements, and you go in and you actually activate these features for your account. So for instance, if you have an account with Fidelity and you want your shares to be lent out to people who want to borrow them, you'd have to go in there, you'd have to physically fill out the application to be accepted into that program, and then have your account activated so that if any of the shares, any of the stocks that you own were in short supply, they could then go into your account and lend those out to people. And if your account is with any of these major firms and you don't want it to happen, it's not going to happen without you knowing. You have to actively apply for the program, and there are actually requirements. They don't just let anybody in. You have to demonstrate, a large enough position size of certain stocks. You have to demonstrate a certain size of account. You have to demonstrate that you're not going to be, trading in and out of them. And so there are requirements. They don't just let anybody do this. Now, the final way that you might be lending shares without knowing is through a mutual fund. Everybody knows that index funds and passive investing is all the rage these days, and it's the best way to invest because it's the most time-tested and proven and lowest cost way, and you can't beat the market, so you might as well just pay the lowest cost possible to reach the, to achieve the average the same as the market. Now, index funds fees have been going lower and lower and lower over time, and it was just a couple of years ago that Fidelity for the first time came out with a mutual fund, an S&P 500 mutual fund that had a 0% expense ratio, no fees inside of the fund. Now there are others. Schwab has some, Fidelity has more, Vanguard has some, but it wasn't until recently that this was able to happen. Now, if you think about it, there are costs associated with running a fund. Even if it's an index fund, there's at the very least like the electricity costs to run the computer that's going to be buying and selling to maintain the proper allocation to the stocks that are in the index. So there's going to be some costs associated with it. So you might be thinking, hey, if that fund itself, that mutual fund is charging a 0% expense ratio, that means that Fidelity or Schwab or Vanguard, that means they're actually losing money. They're burning money on that fund. They're not making anything. This is where securities lending comes in. Most of the funds that charge no expense ratio in order to manage the fund bring in a small enough amount of revenue from lending shares in that fund. So if there's an S&P 500 mutual fund, and let's say it's got, $1 billion inside of it, and there's one of the stocks inside the S&P 500 all of a sudden becomes hard to borrow because everybody wants to short it, then the fund manager has the right to take the shares from the stock that's held inside that mutual fund and lend them out and collect that small interest rate in order to fund the operations of the overall mutual fund. So really, those are the three ways that you might be lending out shares. Number one, you're investing or trading with a broker that just had that clause snuck into the account agreements, and you had no idea, but it's happening, and the broker's just keeping all of the interest for themselves. It's not likely. You can look into it and see. If you're trading with any of the major discount brokerage firms, like the large ones like Schwab and Fidelity and Vanguard, TD Ameritrade, E-Trade, Interactive Brokers, probably not happening. The other way is to actually sign up for a program like this. And then finally, if you hold index funds with low or zero expense ratios, it's very likely that some of the stocks, some of the time inside of that fund are being lent out in order to fund the operations of the overall mutual fund. So what are the pros and cons? Why would anybody ever want to do this? Well, quite honestly, it's extra income. Just to look at a recent example, let's say that you're an investor in GameStop, and let's say you didn't just jump on the GameStop train last week at the high of $450, but let's say you've been investing in them for years. Let's say you were getting in around 2011, 2012, maybe you've got an average cost of $10 to $15 per share, and you just love the company. Let's say you grew up going there as a kid, and you just, you hold these shares and you never plan on selling them. Now at this point, you might be thinking, in a squeeze like this, when somebody owns the shares, why would they want to make it easier for somebody else to borrow these shares? Well, it can be extremely financially beneficial. Like I said, at certain points, some of these stocks that are heavily shorted can be paying an interest rate of over 100% annualized for as long as those shares are being borrowed. And so if you've got your GameStop shares that you've owned for years, you're never going to sell them. Why not hold them in a lending account? And then as needed, your broker will go in, they'll borrow the shares, they'll give them to whoever wants to short them, and all of the interest that the borrower is paying to your broker, they are going to split with you, and usually it's something like 50-50. So you'll get 50%, your broker will get 50%. This is why at some brokers, they actually call these programs like yield enhancement programs, because quite honestly, if you've got a large portfolio of individual stocks that you plan on not selling, you don't trade them, you're just holding them, why not stick them in one of these lending accounts and you still get to own the shares? You still can, you have all the freedom you want. You can sell them at any time. And let's say somebody's borrowing your GameStop shares when you decide to sell them. Let's say it goes up to 400 and you're like, this is ridiculous, I'm getting out. As soon as you get out, whoever borrowed those shares, they can be called back. And so there's always the risk of a borrower, if you've shorted shares, somebody shorted your shares, that those shares can be called back at any time. They're going to have to close out their position, buy them in the open market to deliver them back to you so that you can sell them. And so depending on the stocks that you own and how hard to borrow they are in certain market conditions, it can be extremely lucrative and increase the yield of especially like a dividend, an income producing portfolio can increase the yield and be very financially beneficial for you. Now, there's always trade-offs, right? So those are the pros. Basically, you make more money. What are the cons? Well, the shares that you lend out may not actually be protected by SIPC. So in the case of, let's say, your broker becoming insolvent overnight while the shares are loaned out, there's always the risk of, something crazy like that happening. So because of that, brokers are required to post 100% cash collateral in your account in place of those shares while they are being borrowed. Now, another con to this is that typically, if a stock has a high short interest, there's a reason for that, and many investors believe the stock is going down, and so it's possible that even though you might be making some interest on allowing your shares to be lent out, you might still be losing money overall if the stock is just going down and down and down and down. Now, obviously, there are cases where there are squeezes and you can make money on both sides, but this is obviously one of the cons with participating in a program like this, is that you're owning shares that might be expected to go down. Another con is that you don't have control over any of this. You would just have an account with your shares, and at any time, any of those shares might be borrowed from you. And once you've signed up for this program, you're not going to they're not going to have to get permission from you. That's why you do this. You say, here's all my shares, here's all my stocks, borrow them at any time, and they may borrow them, they may take them, they may lend them out, and then they may return them at any point. So you really have no control over it, other than signing up or not for the program. Another con that may or may not matter to you is that voting rights you suspend your voting rights while those shares are being lent out. And finally, most of the time, this can only happen in an account that has the shares fully paid for. So you wouldn't be able to do this with an account that is leveraged, like a margin account. These shares would have to be fully paid for, and so if you were ever needing to pull money out, you wouldn't be able to do it from like a margin loan. You'd have to sell the shares or withdraw them from the program. So that's about it. And as you can see, apart from the isolated incidences from like recently when people are saying, screw the hedge funds, we don't want any of these shares out there to be borrowed, most of the time, this is a fantastic way to just earn some extra income on shares, especially if you're going to be holding them long term. You don't care about short-term fluctuations. You believe the company is strong going up long term, and other people don't, and so they want to pay you interest in order to borrow those shares. Hopefully that helps you make a more educated decision. If you were concerned about this happening, you can either make sure that it's not happening, or move your account somewhere where it won't be happening, or maybe now you see the benefits and you'd like to sign up for a program like this for your own shares. As always, I really appreciate you guys. Have a great day.